If you own a building, a rental property, or even a business with equipment and vehicles, there's actually a great chance you overpaid your taxes last year. And this isn't a little amount we're talking about. We're talking about tens of thousands of dollars in some cases. The wild part is that it's completely legal to avoid, and the IRS actually wants you to take this deduction, okay? And most people don't know how, or their accountant never brought it up. And this magical thing we're talking about today is depreciation. And in the next 4 minutes, I'm going to show you how it actually works and how to use it without triggering an audit. That's the most important part. So real quick, if you don't know who we are, my name is Sargis. We're with Next Level CPA, and we help business owners and investors legally minimize what they pay in taxes, and we turn those into long-term wealth for those families. So yeah, let's get right into it. So here's kind of the core idea. When you buy an asset that lasts more than a year, think about something like a building, machinery, a work truck, the IRS doesn't let you deduct the whole cost the year you buy it. Instead, you deduct it slowly over its useful life. So a commercial building is spread out over 39 years, a residential rental is spread out over 27 and a half years. So that sounds slow and boring, and honestly for decades it was. You'd just, get a small deduction every year and just wait. But what's changed the game is that you don't have to treat the whole building as one 39-year asset. A building is made up of parts, so the wiring, the flooring, the landscaping, the parking lot. A lot of these parts depreciate way faster, over 5 years, 7 years, 15 years, instead of just 39. So if we can front load these deductions and you can dramatically cut out your taxable income, then that's just going to be better for you, right? So how do you actually capture all this? So there's 3 big moves. Move number 1 is going to be the cost segregation. So this is the study done by engineers and tax pros, and that breaks up your property into faster depreciating components. Instead of deducting a sliver over 39 years, you get to reclassify big chunks into 5, 7, and 15-year buckets. So on the right property, a cost segregation study can actually free up 6 figures of deductions just in year 1. The study costs money, usually it's a couple $1,000s, but the tax savings often dwarf that many times over. Number 2 is called bonus depreciation. So this lets you deduct a huge percentage of these shorter life assets immediately in the first year. When bonus depreciation is at 100%, like it is right now in 2026, that's that cost segregation that we were just talking about. It can wipe out all of those 5, 7, and 15-year components in year 1. Okay, so that creates massive first year deductions. So number 3, you have to actually be able to use the deduction. So if you're a passive investor, then those losses get trapped as a passive loss when you can't just wipe out your W-2 income with them. So there are ways around this. It's called the real estate professional status, the short-term rental grouping elections, but they have really strict rules and we'll probably go over them in another video. This brings me to the most honest part of the whole video. Done right, this is one of the most powerful legal tax strategies out there. And if it's done wrong, the IRS will come after you. So don't be sloppy in your execution and definitely consult with the CPA. So here's what I do. If you own a property or significant business assets and you've never heard of the words cost segregation from your accountant, that's definitely a conversation worth having before year end, not after. The planning window closes when the year does. If you want help figuring out whether this applies to your situation, drop a comment below or reach out through the link. And if you got value from this, subscribe. We try to break down one real tax strategy like this every week in plain English. Yeah, thank you, and we'll see you next time.